Red Swan is here to revolutionize and be a major disruptor of the commercial real estate industry. You know, the real estate industry, especially the commercial real estate industry, is a $22 trillion market worldwide. And this is really on the institutional grade assets that we've been focusing on, that I've been focusing on in commercial real estate for the past 17 years with Cushman & Wakefield, as well as with companies like Colliers International. And we see that the disruption is very important because it allows smaller investors now, for the first time, to have an opportunity to actually invest in quality properties, invest in real estate, good quality, high earning, high appreciating industry, real estate that they never had the opportunity to invest in before. So we are very happy to help the underserved. But on the other side, we're also helping, there's most people who acquire real estate or have been acquiring real estate for a long time are wealthy. Real estate is in the top, people who own real estate are in the top 10% of the wealth around the world. So we're also focusing on helping those owners to acquire more and more real estate and generate higher yields with the real estate. And we're doing that through merging real estate to the blockchain and then taking the blockchain and tokenizing these assets. So we're excited about that because we see the demand, and we see customers coming to us and asking for properties to buy with their $1 million, $2 million, even $5 million worth of investment, and there's not much available that they can buy. So by tokenizing these assets, we're now creating a market for smaller investors to come in. Now, what does tokenization mean? Tokenization is basically taking a pie and slicing it up into millions of pieces. Because one of my friends told me in Nigeria, where my family comes from, so the young kids make money by running to the market and buying a bar of soap, and they come back and they cut the soap up into 10 pieces. And then they will sell each cube of soap for, let's call it a quarter. But yet they make, $3 from $1 worth of soap. So that's the same theory when you think about tokenization. We take a $50 million property and we break it up into 50 million tokens. And so now that token value, what we call security token, is worth $1 in terms of par value for real estate. But when you try to sell it to the open market, people now are willing, because they can buy just a small share, they're willing to pay $1.25 or $1.50 for that same token because they don't normally have the opportunity to buy an asset of that quality. So they're excited about this opportunity, and we're excited as well because it really helps the entire capital stack when you look at commercial real estate. Traditionally, commercial real estate is illiquid. What that means is that you make an investment in commercial real estate, you're in it for the long haul. You buy a house, you're usually not going to buy a house and then sell the house in 1 year or in 2 months because the cost is too high. So when you buy commercial real estate, you usually have a 7 to 10 year period in which you're going to hold that asset and allow it to appreciate in value, allow it to receive cash flows. But typically, commercial real estate and real estate in general is illiquid. So what we're doing with tokenization is we're really providing liquidity for an asset. What does that mean? That means that you can buy a property today and hold it for 6 months, 1 year, collect your dividends on the property, and if you decide you want now to go back to having cash, you can take your tokens and sell them to a private party, to a third party, or to an exchange to the open public. But it allows you to divest from that asset very quickly within a short period of time. We think the liquidity factor actually brings a higher value to real estate, because with less risk, you have a higher value. People will pay more for something that has less risk. So if you had two options, one is to buy a piece of property for $10 million, but your asset is stuck for 10 years and is going to appreciate or give you 10% cash on cash, versus an asset that you buy for $11 million and is the same identical property, but you can exit that property within a year and collect any dividends within that year that's been declared for you. There's two different asset levels of risk, and we believe that the lower level of risk is going to be more attractive to investors.